What's up, everyone? It's Scotty with MoneyVest. So Moody's changes the U.S. credit outlook to negative. They kind of kept the rating intact. They didn't really change the rating, but they did mention that the credit outlook is negative and concerning, considering the fiscal dysfunction or congressional dysfunction that's happening with respect to fiscal policy. So I'm going to break down the consequences of that. Obviously, we did see the yield not respond very well on the back of the weaker demand for U.S. 30-year treasuries. And as a result, I think that's probably one of the reasons why Moody's came out and changed the U.S. credit outlook as well. And we also, again, have the net short positions on U.S. treasuries, the highest on record based on a levered basis. So we're going to break that down as well. So I hope you guys enjoyed this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. This right here are pretty much all the benefits that you can expect. You can get access to members only private videos. There's over 42 plus private videos that you can access and unlock. You do get access to our spreadsheets. So these are intrinsic value spreadsheets, S&P 500 valuations, volatility cheat sheet, retirement calculators, debt calculators. A lot of the things are going to be included. And of course, you get access to our Discord channels, over 20 plus Discord channels, including trade alerts, options alerts, discussions. Everything's going to be included. So link's going to be down below. There is a 16% annual discount, and we'd love to have you on board. If you have any questions, feel free to reach out at any time. So Moody's changes U.S. credit outlook to negative. Moody's reaffirmed America's credit rating at the highest AAA level, but expressed concern about nation's fiscal trajectory amid congressional dysfunction. So the rating itself was changed to negative from stable on Friday by the ratings firm Moody's, which pointed to the nation's worsening fiscal position and political polarization as long-term concerns for America's economy. And the change falls short of a downgrade to America's credit rating, which Moody's maintained at the highest AAA level. But we also learned that in August, Fitch lowered the U.S. long-term rating to AA plus from the highest standard AAA. And that downgrade 2 months after the United States narrowly avoided the defaulting on its debt, which would have been like the second in America's history as well. In the context of higher interest rates without effective fiscal policy measures to reduce government spending or increase revenues, Moody's expects that the U.S. fiscal deficits will remain very large, significantly weakening debt affordability, and continued political polarization within U.S. Congress raises the risk that successive governments will not be able to reach consensus on fiscal plan to slow the decline in debt affordability. So really what they're saying here is, number one, there is no plan to increase revenues. We did get the IRS's new tax brackets, over the weekend as well. But there's no clear plan on increasing revenue. In fact, revenues went down. I did a video, on that earlier, I think in October, when we talked about the Congressional Budget Office and the revenues that they've collected. They've declined because 2022 bear market also resulted in, significant amount of unrealized losses. So there wasn't a lot of capital gains to tax on for folks. And that's why they're going after, companies like Microsoft and even higher net worth individuals. So that's number one. The second problem is the deficits continue to become larger and larger, right? We also learned from the refunding program last Monday, I think, or was it this Monday, where they're going to now plan on spending another $1.5 trillion in the fourth quarter of this year and first quarter of next year. So a little over $800 billion this quarter and another $750 billion next quarter. So that continues, and the debt levels continue to increase to over $33 trillion. Now, what's actually happening is that the U.S. is now borrowing at very, very high rates, right? Because the long end of the curve and the short end of the curve, they're both really high, right? They are now borrowing at very, very expensive levels. And this is really kind of detailed out in Ray Dalio's books and what he's talked about, like the debt crises, where, it's kind of like a never-ending spiral. If it actually starts, this can really be disastrous, unfortunately, from a debt perspective. And the reason for that, and look, the U.S. can print its own currency, right? So they've got that liberty of actually printing the reserve currency of the world, right? The U.S. dollars. But if the demand starts to weaken for the US dollar, if the demand starts to weaken for US denominated debt, that's the problem. That's when it actually starts to begin the bigger problem that I'm going over, right? Because then the US will basically need to finance itself, right? The Federal Reserve will have to start this quantitative easing process where they were buying a lot of bonds from the Treasury Department. And what were they doing? They were buying all this debt to lend the money to the U.S. government so they can continue on this spending spree. And while doing that, the demand was stable, keeping interest rates lower. But now that the Federal Reserve is not only rolling off treasury assets from their balance sheet, but they're also doing quantitative tightening by raising interest rates. That's creating a very interesting dynamic that the demand needs to now come from foreign investors, from people, banks that are obligated to actually buy. So the demand for 30-year treasury proves weak, sending yields higher. And that's what happens, right? If the demand's not there, we've been talking about this. If there's an imbalance between supply and demand, prices will come down, yields will go higher, and that's why yields were surging. So the 30-year U.S. treasury yield climbed about 4.8% on Thursday from 4.6.5% the prior day after a sale of $24 billion bonds received far less demand from investors than the government is used to seeing. And primary dealers, big banks who are obligated, right? So these are banks and primary dealers who are required and obligated to finance whatever portion of the treasury auction isn't purchased, right? So whatever portion, whatever's left over that is not purchased by other investors and foreign investors and governments, they bought nearly a quarter of the issuance. So 25% basically came from primary dealers and big banks who were obligated to buy it in the first place. And that is more than double the average in recent 30-year auctions, according to BMO Capital Markets. Now, this is why things get a little bit more interesting, is because the U.S. is now financing debt at 4.8%, right? 30-year U.S. treasuries, they're locked for 4.8%. That average return on the actual debt that the U.S. has is creeping up. Like from a couple of years ago, I mean, we've gone through like a 16 to 18 year period where interest rates were low. So the U.S. had a lot of, flexibility to finance its deficit spending at lower interest rate debt. Now that rates have gone higher and the deficits have only increased, now they're financing all those deficit spending at a higher rate of return. So they're basically replacing old debt, which was at lower interest rate, with new debt at a higher interest rate. Think of it this way. Let's say that you have a mortgage, right? Let's say that you have a mortgage at 2%. What you're doing is you're refinancing that mortgage at 2% to a higher interest rate mortgage at 6% or 7%. That's what the Federal Reserve and of course the fiscal department ends up doing, is because they're refinancing all of that old debt into new debt as deficit spending continues. And as a result, the overall average on the aggregate debt is creeping up and it's going higher. So that obviously is not a great situation. And again, hedge funds are taking advantage of that because they are, again, the highest net shorts that we have ever seen. But of course, we did see a little bit of a pullback in the treasury market. So treasuries did drop over 40 basis points, 10-year treasuries from highs of over 5%, back down to 4.5% after the Federal Reserve, again, gave us a speech, press conference, and Jerome Powell, once again, at the monetary policy panel, talking a little bit more hawkish, but the market's not buying it. Market's still expecting rate cuts on the back of weakening economy and the labor market as well. Of course, time will tell if that ends up happening. But leveraged funds ramped up net short treasury future positions to the most in data going back to 2006. And the bets persisted even though the cash bonds had rallied the week before. It feels like short U.S. Treasuries positioning was an extreme last week, which was an accident waiting to happen. This was Garrett Berry, strategist at Maguire Capital. So price action in Treasuries for the past few months was a classic case of persuasive story feeding the price action until it went too far, leading to an overshoot, which is now correcting. So basically the yields dropping here is a little bit of that correction covering as the $26 trillion bond market swung back to pricing the end of potential rate hikes from the Jerome Powell speech. And the combination of more benign U.S. refunding needs, weaker than expected jobs data, and signs of the Federal Reserve turning less hawkish may have spurred widespread covering of short positions as well. But bottom line is, if there is continued, there's like two forces at play right now. It's two forces going at each other. Of course, the former, which is the fiscal deficit, is significantly bigger than the latter, which is the hedge funds shorting the heck out of the U.S. Treasury market. But it's really just two forces going at each other. And that's what's creating a lot of volatility in the bond market, right? You're seeing yields higher, lower every single week. We're just kind of going back and forth because on one hand, you've got this demand supply imbalance and the fiscal deficit that continues. And on the other hand, you've got the treasury market being shorted to take advantage of it. And it's overshooting to the downside, which is creating some covering. Covering is leading to prices going higher, yields dropping back lower. And market's expectation with Federal Reserve and the rate cuts into next year is causing a lot of bond volatility. Now, what's the end game here? Well, eventually one directional play will end up winning out. Whether it's yields higher or lower, we're going to have to wait and find out. Many people do believe that yields have topped, but given the deficit spending and given the amount of debt that's out there and that's required, I wouldn't be surprised if we do retrace back higher, although I have started to dollar cost average a little bit more heavily into TLT TMF here. because I also do believe that, okay, rates can stabilize a little bit here and start rolling over if the economy starts showing us signs of potential recession or weakness in the labor market or the economy. That's really the thesis behind the bond trade, is if there is weakness in the economy, because that's going to create that sort of optimism around rate cuts, which the Federal Reserve, again, is going to come down to next year. If inflation's back down and there's a recession, there's possibility for rate cuts. If inflation's not back down to the Fed's target and there's a recession, then I think we're in more trouble ahead, because the Federal Reserve is going to prioritize bringing inflation down over correcting a recession. Hope that makes sense. But this right here is really where the S&P 500 should be trading. So now talking a little bit more about the equity market, at 4.5%, close to 5%. Yields, the average P multiple over the last several decades has been around 17.5 to 18. So we're maybe slightly higher than what would be considered as appropriate price earnings multiple on the S&P. But as you guys know, my fair value, at least for now, is sitting at 4,000 points on the S&P 500. And right now we're just kind of crossing over with that breakout over 4,400 as well. So I did a video on the technical analysis earlier today, so make sure that you do check that out. But as always, hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like and subscribe to the channel. Let me know your thoughts down in the comment section below. And, what do you think about the bond market right now with so many different variables and forces at play? Link to our Patreon is going to be down below. Again, you get access to all the members-only private videos. All the spreadsheets are going to be available, and you can also join our Discord. I did open up a few more spots if you're interested in joining. So, always, happy investing. I'll see you all in the next video.